Hey, well, ladies and gentlemen, good afternoon, and thanks so much for joining us on a delightful afternoon. I'm in Florida. The weather is great. David is also experiencing great weather, so thanks for joining us. And I'd like to introduce David Fitzell, who is a Senior Vice President with Meridian Bank. And David, maybe you can just take a minute and introduce yourself to all the people that are with us.
Sure, Jim. Good afternoon, everyone. My name is Dave Fitzell. I head up mortgage lending for the Maryland team of Meridian Bank. Look forward to sharing some of my comments with you today on how we manage our business, and excited to be here with everyone today.
Awesome. Well, David, thank you so much. And today's topic is about working on the business, not in it. It's a little different topic than perhaps I've done before. And the reason we're doing it and how we're going to spend our time today is talk a little bit about two things out of the mortgage banking business, which are the Atlanta Braves and the World Series, and how they actually put together a World Series championship by working on the business, a little bit about Southwest Airlines, and then kind of getting into a question of why some lenders are always profitable regardless of the business conditions, and what are some of the benefits you might take away from these companies to work on your business. So with that, we'll get started. And what is working on the business? When I say working on your business, not in it, what it means is you're imagining of how your business should work, not necessarily how you do your work, and how you design the business process to serve your customers, and how to ensure your team has the systems and processes to create great customer service without necessarily having your fingerprints on the daily ongoing frontline work. And then how you measure what matters against your standards so you hold your team accountable for the results. And whether you're a CEO or a senior manager or a supervisor, all these things still work because it's how you work on your segment of the business, whether it's the entire company, a division, or a particular department. So this is applicable to everybody. So one of the things I did not too long ago was survey senior executives. How much time do you actually spend working on your business as opposed to in it? And I was a little surprised at the results. About 30% of the respondents said they worked on their business more than 50% of the time. What that means is for people that are working 0 to 25%, they're working in the business all day long. And again, nothing wrong with that, except that it's really hard to effectuate meaningful change and a lot of growth if you're always just focusing inside. So what does working on the business mean, and does it really matter? Give you a couple examples. The Atlanta Braves, I've got 20 years of postseason results here, starting in 2001. And as you look at that, you'll see that kind of pink colored thing on the right-hand side. And that's a nice way of saying you lost. But something changed in 2021, and they won the series 4-2. So what changed, and what might you as a lender think about as a lesson coming out of the Atlanta Braves win? And what they did was a data-driven defensive realignment that was situational, and it moved their fielders away from the traditional fielding points for each particular batter. In this case, I've got a right-hander up here. And what they did was, if you look at that little green triangle, that's where generally the statistics for a particular batter that was the subject of this slide would put a ground ball out. So you see on the left-hand side, you have two fielders that are really in a position to field. And when you shift, for this particular batter, the infield would shift to the right, and you'll see that you have 50% more defensive strategy available. So by that simple little shift that's based on both the batter, the pitcher, and the pitch count, those shifts really allowed the Braves to do something really different. And here's what it was. Prior to 2021, they shifted very rarely. In June of 21, when they're pretty much middle of the pack in their division, they adopted this shift. They talked with their team and they said, we're really going to use this shift technique and see what happens. And they shifted significantly more all the way through the end of the season. And the question is, does it work? And the answer is, yeah, it worked. So the first time in a very long time, the Braves ended up with the World Series championship based on data-driven decision and some movements and strategy. And our thesis is you can do the same in your business. I mentioned Southwest Airlines. So how do they work on their business? If you think about it, Southwest is in the commodity business. They're moving people from point A to point B. They're using either Boeing or Airbus equipment, not too much differentiation. But they've been a profitable airline 50 years in a row up until the point of COVID. So they worked on their business in a way that Dave will talk a little bit about in terms of his management style. But they have a single fleet of airplanes. They use Boeing 737s. And even when they did an acquisition of AirTran, they disposed of anything other than the 737 fleet. And the reason is if you have a single aircraft, the same pilot can fly all the aircraft, the same mechanic can fix all of those same aircraft. And when you have a failure, the maintenance parts, the inventory, everything is available because it's the same type of aircraft. And the other innovation is they used a point-to-point route. Instead of going through hubs, they went directly from one point to another point. Those innovations have resulted in a 20 to 25% sustainable cost advantage over time. And David, I think you have a comment on this.
Yeah, so in a lot of ways, our model at Meridian has been to follow the Southwest Airlines kind of concept where we're really focused on the key things that we do well, and we try to focus all of our efficiencies on those things. When we looked at models in the past where they kind of create silos, it doesn't allow for great efficiencies. It doesn't allow you to really sharpen your price to the customer. And so we built a model based on fairness that's really driven to drive customer value as really the main focus of our model. And that's really worked well through a lot of different market cycles to ensure that we always remain profitable. And so that's really, our business looks a lot like the Southwest model here that Jim's proposed or sharing.
Yeah. Awesome. And you'll have a chance to ask Dave questions at the end. If you have them, you can type them in chat, and Mauricio will keep track of them and serve them up to us at the end of the formal presentation. So Southwest Airlines working on their business, it's simplicity, it's creativity, it's that innovation of point-to-point routing, and the end result was a consistency of 50 years of profitability. So let's swing into the mortgage business. We spent a couple minutes on Major League Baseball. We spent a little time on the airline business. So here's how you might think about working on your business and not in it. The first part is, how do you want your business, division, department to work? Not how you do your work, but how should the department work so that your business process serves your customers, whether they're internal or external, that you've committed to provide. And how do you have those systems and processes to be efficient so that your team can do its work and do its work well without necessarily having you spending your time fixing problems and working in the business unless it's absolutely necessary. So one of the things I'm going to do is Mauricio is going to put a poll up, and we're going to ask you some of the areas of potentially working on the business, whether it's better margin, better efficiency, better profitability, or better service level management. And feel free to just click one or more of these, and based on your input, we'll show you the results of that poll in just a moment. And then we'll kind of alter how we spend the rest of our time based upon those poll results. So take a minute, fill it out, click one or more, and in a couple of seconds, Mauricio will present the results. So appreciate those who participated. Better efficiency and better profitability seem to be at the top of the list. So Mauricio, thank you so much. That's where we're going to spend our time, and we'll pivot to that. So I think it's appropriate that those two topics kind of came up in terms of efficiency and profitability, because the mortgage banking business has a dilemma. Regardless of volume, and we've had some tremendous volume in 2020, it's broken into the first half and second half of 2020, and 2021 is similar. But our costs haven't really changed on a per loan basis. And if you look at the 2021 data, the costs have actually begun to tick up again. So this cost to produce affects and is an indicator of both the efficiency and profitability, the two topics you wanted to spend time on today. And when you look at where this is, nothing's happened since 2016. And essentially, the data goes back from the Mortgage Bankers Association to 2009. And when you inflation adjust and loan size adjust, virtually nothing's happened with the cost to produce. What that means, and these statistics kind of startled me a bit. In the center is, a paper loan file, what it costs to produce a loan at retail in terms of operations level, labor. It's about $2,400 according to the MBA. The cost to assemble a Buick sports utility vehicle with union labor is about $2,300. So it's hard for me to get my head around. It costs so much more to do a pile of loan file than it does to do the sport utility. And part of that is because virtually 65% of the costs in mortgage banking are compensation related and not automation related, they're compensation related. And interestingly, only about 7 or 8% of the costs are technology. Dave, any observations you have here, or do you want to move on?
Yeah, so one of the things we're talking about a lot with our team as we work on the business is how do we drive greater efficiency? And in mortgage lending in 2021, it really comes down to your people cost. And so we've created a lot of different optionality within our team so that we can do more with less people. For instance, some of our shippers, help close out files and different times of the month. We've tried to cross-train our team to really get the most out of them. We always have room on our team for A players, and we're always trading up, to use a baseball term, with our team. And we're trying to use data to really, help us drive that value creation so that we can give a sharper price to the consumer.
It's interesting. One of my friends that got me really thinking about this kind of manufacturing cost in this centerpiece here that I just circled is Jonathan Core. And Jonathan is the retired president of ICE, or at the time Ellie Mae and ICE Technologies, with the Encompass loan origination system. And his comment to me was, Jim, people tend to solve issues in the mortgage business with human spackle. And I was taken aback by that term, to think about human spackle. What I had is a vision of people just thrown up against the wall. And he said, what happens is when you need to do something or something changes, instead of really thinking about how to do it better, faster, cheaper, the answer is, hey, we got loans to do. Let's just go add some people to this and we'll deal with it later. But in the interim, we just got to get loans out the door. That is the classic definition of working in the business, of just adding bodies, adding people, and not necessarily reflecting back about how can we be more efficient? How might we think about how we evaluate people? Dave made a comment about trading up, and we'll talk about that in just a moment. But when I use the term human spackle, it has a visceral impact on me, because it says we're doing two things. One, we're putting costly labor to solve a business problem. And second, it means that the job content of people who are just pushed into, hey, clean this up, or look at this, or check this, or checkers checking checkers, it's a huge issue. And it's remained a huge issue in our industry. So why are some lenders profitable regardless of the business cycle? The story behind this is I do a fair amount of work with a lot of lenders and have probably worked with about 300 in my times with Teraverde. And some of them are always profitable no matter what, and others have wild swings of profitability. And the question is, why and how are some lenders always profitable? So we talked about working on the business, and we selected profitability and efficiency as the main ways that you're going to do this. One thing, if you'd like to explore this concept a little bit more about working on the business with a playbook, there's a link down, and Mauricio will get this out to you after the fact, and you can get some ideas from that. But based upon your wish of the group, we're going to look at two areas: profitability, efficiency. The first one is profitability. And when I think of profitability on the origination team, a couple items come up to mind. And David, maybe you can just quickly run us through what each of these are and how you think about it. And then after that, if it's okay with you, I'm going to kind of share a screen of how you're managing that. Is that all right?
Sure, absolutely. So what we started to look at several years ago is how do we effectuate basically delivering a great rate to the consumer and also making sure the bank was profitable in all cycles. And what we learned as we really focused on that was that all of these things matter. So the volume of your loan officers, pulling out kind of your weaker players to trade up to, loan officers, quite frankly, that know the business exceptionally well. The contribution of profit to margin is primarily driven not just by how you increase your margins. A lot of companies during this last period just pushed up margins because they could. We took a little bit of a different position where we built a lot of goodwill in the realtor community by keeping our margins consistent and ultimately, offering great rates, which then for made happy customers that gets referrals and, hopefully we'll have a long tail as we go into the next market cycle. Concessions and cures are one of the things that we focus on a regular basis in our business. Those are the spoilage, the things that we can control, but often we don't control. And so we looked at ways to identify them and be proactive to lock down our system so that we can mitigate those terms. And we were greatly successful in a lot of those efforts. As a publicly traded company, I have to stay away from specific numbers today, but we made great strides to this, and it definitely helped, which allowed us to really do our core thing, which is keep our core team intact during any market cycle. And so we've been able to do more with less people because we focused on these things. Turnaround times are incredibly important in a purchase money world, which is what 2022 is going to be. And so in order to compete, you've got to be able to pick up a loan and close it in 3 weeks or, as fast as necessary in order to have that reputation that we close loans. And I think we've executed on that exceptionally well in our local market and on the national market. And then pull through. If you really start looking at pull through, those are wasted opportunities that you're not capturing. And I think a lot of times you have to ask yourself, why? Was it that your rate wasn't competitive enough? Was your process not fast enough? There are a lot of different reasons that factor into that, but these are all things that we proactively wanted to manage in our business and spend a lot of time talking about all of these things, because at the end of the day, to drive greater efficiencies and greater profitability, they all matter.
And one of the things that Dave and I share is a common bond about how one trades up to get the best performing team you possibly can. In my book on strategically transforming the mortgage banking business, I had a chance to talk to Billy Bean of the Oakland Athletics, and Billy was kind enough to share the 5 things that he really looked at, the 5 tools in each player that was important to him. And it was pretty interesting to me because, when I first meet a mortgage executive or a banking executive, and I ask them, tell me about your mortgage business. Invariably, the first thing they say to me, what is it, Dave? Well, our business does what?
Volume.
We're 1 billion, 500 million, 27 trillion, whatever it is. it's the single metric, but it really isn't the single metric. And when you look at what makes a profitable loan originator or direct-to-consumer originator or wholesale executive, it comes down to these tools. And yes, volume's important. And what you have right here is volume. And you can kind of see the trends. But more important to that, or equally important, is margin. So you've got margin. You can kind of see what the trends are. And then you've got turn time. So how fast does this close? Cures and concessions. And then you've got pull through. So when you do that and you look at a balanced scorecard, you begin to see who the top performers that are good at all 5 of these things. And as you'd expect, as you kind of scroll down, when you get to the bottom of this list, you find a lot of things that aren't so good. And Dave, you might talk a little bit about why there's a need to trade up and how that impacts your business, and how the visibility to kind of look at these 5 things simultaneously helps you motivate and recruit.
Sure. So one of the things we identified was that lower producers ultimately clog our system. And so we've done a very good job of creating minimum standards. It's hard to give up volume. As mortgage lenders, we want all the volume we can, but when you actually understand that, that slows down your underwriting turn times, which then hurts your customer service, or the deal doesn't make it to the closing table because of just lower loan officers, quite frankly, in a lot of cases aren't as experienced because they just don't do it as much. So it's like a pilot, in Jim's scenario here. Do you want the guy that flies 1,000 flights a year or 4? And we really focus on the team and focus on this one team concept as we focus on profitability. And that's really driven great results for us. I was honored to be able to help Jim create some of these metrics that he uses in this COES product, which allows us to proactively manage our business in real time, which is exciting because for the longest time, we would work off of spreadsheets, and we didn't have this technology. We kind of instinctively knew kind of how these things, came in, and we'd run our Excel spreadsheets. But with this technology, I can go in real time into my system and say, who's meeting the mark and who's missing the mark, and what do we need to do to coach them up? We've been exceptionally blessed to have my partner, Jeff, whose gift is, coaching people and building organic loan officers over the years. And it comes because he's willing to invest the time to push them and coach them up. And so this helps us identify who we need to spend our time with to see if we can make them, truly a top performer, an A player, as far as loan officers concerned.
And Dave, one of the things I took away from just looking at your results is the consistency of how you've been able to get your team to do adequate amounts of volume at a good margin with good turnaround. And the variability on your team is much tighter than many of the lenders I've seen. And I think that comes from the visibility of being able to coach up and also to set pretty clear expectations. So wanted to get you had a very interesting comment to me as we were speaking one day about pull-through. And, pull-through is factored by 2 things. One is declinations, in which we as a lender decide, no, you don't qualify. But the larger element is withdrawals, where the customer decides they're not going to do business with us, even though we would be willing to do business with them. So they decide. And I was with a CEO, a relatively large lender, and this CEO said to me, withdrawals are just a cost of doing business. And when you look at withdrawals, it's really work you've done on a file and for a borrower that didn't result in any economic benefit to the lender. And the economic benefit is one thing, but you also lost a potential customer. So I pulled some statistics here from an anonymous source. This is a live lender, but it's not Meridian, it's somebody else, and looked at the pull-through, specifically withdrawals. So I went through and said, show me all the withdrawals. In this particular case, 2,675 files withdrew. And the amazing thing was a 735 FICO, an 83 LTV, and a 35 DTI. So if you think about going back to that cost to originate, if you take nothing else out on working on the business, it's thinking about spoilage, meaning how many loans could have you done, but the customer withdrew because of any variety of reasons, follow-up, price, you name it. But if you converted these withdrawals back to business, just look at what's here. It's $370 million of purchase business, which maybe the deal fell through or something, but there's a lot of refis, no cash out refis that walked away, a lot of conventional and govy business that walked away. But look at that credit box. When you look at the credit box here, the majority of this is above 680. There's a large amount of this that's under 95. And there's a significant part of the credit box that's under 43. So these are not hard to do loans. In fact, they're probably pretty easy to do loans. So Dave, I'd love your thought on the CEO's comment that said, 19% FOB, just a cost of doing business, Jim.
Yeah, we focus on pull through. There's costs associated when loans don't make it to the finish line, and so that's always a topic of discussion with our team. And this, ultimately helps us track that. Our pull through numbers are really quite high, and I think that's driven by we're competitive on interest rates. We're making sure we're always in the market, and so I think those are some of the ancillary things of why you would have fallout. They got a better offer from another lender or something like that. We've tried to position our model so that's not really impacting that greatly. So
there's another lender that looks at fallout as a hidden treasure, and that hidden treasure is we know the customer, they fell out, and if it's a purchase transaction, there's always a chance that the property fell through, but it's still an opportunity to re-engage. On a refinance, it's a chance to go back and say, so what's it going to take to earn your business? And this particular lender is able to push that withdrawal rate from that mid-teens down to a low single digit, because that lender says, I'm going to recover every one of these customers. Even though they're withdrawn and maybe I closed the loan, I'm going to go back to them and maybe have a really low cost option because I already did most of the work. I know who they are. I know what they're interested in. And the idea was to recover 2 out of 3 of those customers and book that business. So they have a very low cost way of doing it because it's not an originator who's going out and finding the business. It's somebody going in and recovering the business. So another thought, one is just to systemically work it. And when you do have that fallout, think of it as a hidden treasure. So margin performance, how do you measure your people? And I'd love you to just kind of go through and give a sense of what you're thinking about in terms of managing concessions, cures, and mix to make sure that your branches and your originators are giving you the top line performance that you want. So Dave?
Yeah, so the way we've built our model is really just a common margin that's built to win the business. So it doesn't matter the product type, we're conforming to one standardized margin. And then ultimately we're building off of that with lender credits to compete with deals to win the business. So all of these factors, play into it. But at the end of the day, the volume, the product type, largely in 2021, it's a conventional market. And so we're competing on, government loans as well, but a large percentage of our business and the industry, I think, has shifted to conventional lending, which means that margins in a lot of ways are suppressed or about to become more suppressed. And so we're focused strategically on making sure that we're in the market on price, and yet, our efficiencies are allowing us to be profitable at those levels.
So let's talk a little bit about concessions and cures, because I know you have a big focus on managing that and setting expectations. A cure is a self-inflicted wound because it's a disclosure issue. But tell me a little bit about some of your views on concessions and how to avoid them.
So what we do is we look to identify with basically software how to avoid those from happening repetitively. We made that a big exercise throughout the year to go back and fix our system to fix some of those cures. And we look at that as an aggregate all-in margin. So we hold our loan officers accountable to the net margin impact that occurs on a loan. And we make sure that we're always, talking to them, explaining to them in a team, setting, these are the things that occur. This is how we're going to prevent that going forward. There is going to be cures, just the way, things are set up. It's almost impossible to get rid of them, but it has to be part of the financial discussion as you set your interest rate policies and your business policies and your model.
Yeah, awesome. Thank you. So we also talked about efficiency and productivity. So a little bit about your thoughts on how you manage the operational team and how you make sure that service levels are attained, and how you maybe anticipate service level issues and solve them in advance. So would love your thoughts there.
Yeah, we've taken a much different approach. We don't allow teams at Meridian. We have a team, and the team is always pulling in the same direction. So we have some, great professionals that I have the pleasure of working with. And ultimately, what we've done is we've gotten them to all pull in the same direction. We create basically a balanced environment where everything's created on the ebbs and flows in the market. So what we experienced in 2008 led us to creating a model that expands and contracts based off of market conditions. So our expenses expanded during this last period with incentive compensation, and then they naturally actually fall as we head into 2020 if there's reduced volumes. So we've expanded and contracted. What that's allowed us to do is keep our team together and not lose, A players during market, movement. It's been a really fair model consistently across the board, and it's allowed to greater service levels because we have people that are well trained. We're not training people on the fly. We basically just retain our team, and during this last period of time, they were able to do a lot more because they're used to working as a team. One of the things that we do is balanced load. And so we have the ability in our operations team to pull from different branches, different processing staff or different underwriting staff, because it's all just one unit. And I think that's one of the things that has ultimately allowed us to do a lot more loans with less people than a lot of lenders, because I think that's the mistake a lot of people have been making, Jim, is that during these crazy times where volume just expands, they just add people, and a lot of times they're adding them at a branch level. And so as the volume starts to shift, it makes it very cumbersome to get those efficiency gains or the reduction in staffing without causing other disruptions in your volume as you start to recalibrate your business. So this expanding and contracting that we've used over the years in our models worked out very well for us.
Well, David, and thank you. And I think one of the things, just for the folks that are on our discussion today, is that what David is describing works really well for David and his team. It may not work for you, but the important thing is that David has thought through on how these issues all relate to his business model. And you may have a slightly different way of looking at things, that your model may be different. It doesn't mean that David's is exactly perfect for you. What we wanted to do is just talk about how to think about things in terms of the degrees of difficulty of loans being done, how well one achieves service levels, and how you self-correct those SLA exceptions, making sure that you don't end up with operational issues that cause concessions or cures, because it's not just the front originator that might affect a concession or a cure. Sometimes it happens, well into the loan process. One of the things that one of our lenders kind of shared is how they are using some of the things that encompass to really highlight the yellow and red type approach to service level. So if you use this particular product, a short plug for SpeedPath, you really get your frontline being able to see service levels when they're warning, meaning they haven't yet failed, but they might, or red, which is they failed. And what people have told me is when you give that type of visibility to the frontline, 99.9% of the people in an industry want to do a great job, but they always don't know what they're supposed to do or when they're supposed to do it. So to give that front line the coaching that says, hey, this service level, you should have ordered this appraisal, this needed to be underwritten, this needed to be cleared to close. That yellow is, oops, I got to get that done in the next 24 hours or 48 hours. And red is, I didn't get it done and I need to act on it. So that self kind of management is a key element. And I think Dave has some really good results in doing that kind of expectation of what people do up front and what is done in order to meet those service levels. I think the other thing that we can talk a little bit about, getting back to profitability directly, is to kind of look at the whole view. And the whole view is gain on sale, it's compensation, it's other costs. And what, and Dave, again, I'll let you kind of riff on this a little bit, but when you look at a particular loan officer and you look at their revenue trends, their expense trends, and their profitability trends, and profitability is against expectation, you can see some real differences in performance. Would you mind, Dave, just sharing some of the things that drive performance of profitability by branch or by loan officer or by sales agent or by TPO agent or executive? What are some of the things in the behaviors? What are some of the things that you might share with the participants today that work for you, just in general?
Yeah, so I mean, we're really, like I mentioned earlier, Jim, we're focused on delivering a great result for the consumer. And it starts with revenue management to make sure that we're taking appropriate lock times, that we're taking quality files, that we're mitigating those expenses with the cures. And all of those things, like we've been talking about at a granular level, bake into the end result, which is your profit margin. We look at each individual loan officer on a weekly basis through this system that we utilize, that you've created, to really drive those efficiencies and make sure that nothing's out of kilter. And if it is, then we're going to go and we're going to address that in real time, so that we don't, kind of create this repetitive pattern where there's a lot of fallout or where there's a absurd amount of extensions because they didn't lock loans properly up front. Some of the things the loan officer is managing, we want to make sure they're taking a long enough lock that they're getting it to the finish line in that time frame. And if not, why? How can we help them to really drive that value so that we meet our targets, which helps, create happy customers and close loans.
Awesome. So we spent some time together and we talked about working on the business. David has been kind in sharing a lot of his personal observations of what works for him. So one of the questions I have for you before we take any questions that you may have is based upon what we've heard today. Will you be doing anything differently? And one of the key things that happens in my dealing with a large number of executives is you need to make a commitment to yourself. So one of the questions I'd ask you is based upon what you've heard today. Would you mind just sharing on this poll by clicking on the 0 to 25, 26 to 50, 51 to 75, 76 to 100? What's your intent as you finish this year out of how much time you'd spend working on the business? So if you just take a minute, if you wouldn't mind sharing, we collect a lot of data at Teraverde, and this data is always pretty valuable to know what's on people's minds and also, where they intend to spend their time. So just take a minute And once you're finished, I'd be interested just to see the results. So Mauricio, when you're ready, you can share it. Wow, pretty amazing. I mentioned to you early that when I did this poll without actually giving people any reason of what it might be to work on or in the business, only 30% of the people really said they wanted to work on the business, and more than half of them spent less than, or excuse me, 70% of them spent less than half their time working on the business. So I really am encouraged by your focus and hope we've contributed in some small way to help you think about how you spend your time, how to help yourself and your team to become more effective, and to really spend that time working on the business, because whether it's the Atlanta Braves, whether it's Southwest Airlines, whether it's Billy Bean at the Oakland A's, whether it's really any business or some of the lenders that we've worked with, working on the business does increase your effectiveness. It increases your happiness, believe it or not, because you're working on things that are truly important. And it increases the efficiency and profitability where we spend some time. So Mauricio, you can pull that poll down. And what I'd like to do now is leave some time for any questions you may have. And we always try and make sure that when we promise an hour, we wrap it up in 45 minutes. And if there's things you want to talk about, that would be great. Happy to answer questions. So Mauricio, any questions?
No, we did not get any questions yet. You're able to also raise your hand, and I can prop you in if you want to ask a question through voice.
Well, while you're thinking about questions, Mauricio will distribute this recording, so you have a record of it. If you want to share it with anybody, feel free to do that. We'll also send you a couple links that may be useful in your endeavors of thinking and working on the business. So looks like we have some questions. First one is, what types of people training have you put in place to change the mindset on the business? And, that's a great question. I'll go back to an example of the Atlanta Braves. When they decided to do the shift, it wasn't a decision that came from the general manager and pushed down. They brought together the team, the managers, the coaches, and said, look, we've spent 20 years of almost getting there, but not quite. We've been looking at data. We don't shift a lot. Some of the teams that are shifting have had some success. What do you think? So they had a discussion generally with the team about why to do this, why not to do it. And they allowed those changes or those discussions to kind of work freely. And in the end, ultimately, the leadership, the GM, the manager of the team, and some of the key veterans said, we are going to do this and we're going to commit to it. And that's really important, because if this is just a, hey, we're going to do this, it doesn't necessarily mean that you have had the success or you have everybody bought in. So discussing why you're doing it, why you're spending time on what's important, why you're measuring on what's important is really good. And Michelle, thank you for that question. I'm going to move to Kim Hoffman. And incidentally, you've got my email if you want to discuss this further. If that question didn't really work for you or you didn't get the full answer you want, feel free to email or shoot me a call. Kim says, so how do you make the shift of working in the business to working on the business? And Kim, that's a wonderful, wonderful question. And it's really hard, because every day when you go to work, when I go to work, there's constantly problems. As Stephen Covey said in 7 Habits, there's not urgent, not important. There's urgent but not important. And so much of our time is spent on urgent but not necessarily important things. And we get sucked into the detail. There's a book called Essentialism which says focus just on what's essential. And it's part and parcel to being able to elevate your game to work on the business. So a couple ways that might sound. One of the things that one of my favorite executives says to people is, I trust you. I know you'll solve this. I really want you just to do your best and do it. And by kind of reversing that upward delegation of someone coming to saying, hey, Kim, I don't know how to do this. Hey, Jim, I don't know how to do this. Just turn it around and really challenge someone to do it. The other thing, Kim, and it's a great question, is to do it systemically by saying, here's the metrics I'm using. And if you follow these metrics, you'll know what I'm thinking. You'll know where the exceptions are. You'll know what to do. You'll know how to walk that through. And it's lastly, Kim, it's a mindset. It's really just saying, I believe I can do this faster, better. I believe that this can be done. And it's living out that belief, because so oftentimes we get pulled to working in the business simply because we accept that we're going to allow ourselves to be pulled in. So a lot of it's giving your team the confidence that they can solve many of their own issues. It's giving them the visibility so that they can see what's coming and solving their own problems before they become major problems. And some of it's just disciplining to say, look, this is your job. I'm paying you to make my life easier, not the other way around. So Kim, happy to re-engage on that if you wish. Mike Pop, great to have you with us. And you have a question for David. So can you talk a little bit about your success in creating the homegrown MLO team? Loyalty, David, take it away.
Yeah, so we've really given a loan officer a model that they can go out and sell with confidence. And we look for people that are driven, that are maybe underemployed, and we look to give them the tools to be successful. My partner Jeff and I will meet with them regularly to kind of explain to them the mortgage process through educational series. We use other tools that we subscribe to that help coach loan officers that are first-time loan officers. And then we really set up a really great marketing strategy to focus on realtor business with the tools and the products that we know exceptionally well. And we've been very successful building organic loan officers that become top producers with really not any banking background previously. So it's been one of the things that we've perfected over the years, and it's hard to do, and not all of them succeed, as we know, but the ones that do succeed oftentimes turn out to be some of our best producers.
And David, I wonder if you might just share also how the consistency of the training elements and how you ensure that your people are really competent, and the focus you have on training and the commitment to training.
Yeah, so our reputation is everything. We were very reluctant to send out into the community people that are not exceptionally well trained, because it ultimately reflects on our brand. And so we're very cautious about that. We'll put them in an incubator. We won't turn them loose until they're ready to be turned loose, in order to make sure that that brand stays strong, specifically in the realtor community in our purchase money market in Maryland and some of the surrounding states.
Awesome. Thank you. Oh, Kim, thank you very much. David, your fairness model, what's that mean?
So yeah, it starts with the customer. And I talked a lot about rates. What we know is that in order to be relevant, we have to be with the market or slightly better than the market on interest rates. And that's driven by this own it culture that we've created, which Jim was speaking to at a team level. The biggest thing that we've done internally is that we pay appropriate levels of staffing. We've really built an everybody wins culture. So if the customer's winning, if our staff is winning, if the loan officer are winning, and the bank's winning from a profitability standpoint, it really works well. And so we always make our decisions. And this is one of the things that I've had the ball on for many years as far as the strategy. I want to make sure that at all times there's a level playing field with my compensation structure. So in our compensation structures, we have basically 4 different tiers. And it's all based off of longevity in the business, volume metrics. And we've given everybody the same ability to reach those certain milestones, but they have to put in the effort and they have to earn it. And that's something we constantly do from within, is we're always upgrading our team by bringing in new people, but also promoting people within our team that have shown that they're, they put in the effort. We want our team to grow with inside our model. And so the person that used to work, the reception desk, is now one of our operations people that's assistant operations manager. The same thing with one of our best loan officers. They start at the front desk. And so that really creates loyalty amongst the team and allows us to grow with people that we trust, that we know care about our business and our customers and the bank's reputation, which has been delivering a superior result. So I think that's, in too many words, I think that's ultimately, how we look at fairness. And a lot of it's driven by the compensation piece and making sure the bank's profitable also.
Yeah, and David, if I may share your secret formula, if that's okay, without
Sure.
numbers. So David is one of several executives that I've met during my career that runs the business like this. David says this is a fair return in terms of net profit for all that I do, and he has a number in there that's expressed in basis points. And on the top of this is a price point in the market that says, I want to be priced and positioned on different products so I'm at this level, meaning I'm always competitive, maybe a slightly bit more competitive than my competitors, but I always want realtors to realize they're going to get a fair price. Well, if you know what the top line is and you know what the bottom line is, there's only one thing that can vary, which is your cost structure. So how you deal with originator comp, how you deal with processor, underwriter, other costs, and how you control your overhead. This is the true method of working on the business. If you know how much you want to make, bottom line, in all conditions, not just great times, but all times, and you know where you want to price within the market, these are the variables you have to work on, and you have to have the structure in place that, number one, you can see and measure all these elements. So measurement and being able to see it now, not in static reports, not in spreadsheets, but right now, real time. How you see that helps you put your compensation structures together that make sure the mix you're getting, the volume you're getting work, how to compensate your operational team to make sure that they're fairly compensated, that there's a variable element to it, and how you control overhead and how you make sure that investments you make in technology and space and the other tools work. So it's really super important to keep in mind that if you set this as a target and you set your price point this way, you will absolutely find ways to make both these things work. And that's one of the secrets that David, I think, has explained to me. The other element is that when you work this way, it means you are very deliberate in working on the business to say, how am I going to compensate people? What's my mix going to be? Where's my market positioning? What geographies do I want to be in? And this is truly the time to work on the business. And David, I appreciate you letting me kind of just riff on that a little bit from a, this is kind of the magic of how you work on the business, going back to some of the questions. How do you do it? You set your profit level because you should be paid for your work as a business manager. You set your price point, and then everything in between is worked on to get it so this and this work. So David, did I do your model justice?
Yeah, you nailed it, Jim. I think, what Jim's really explaining is you can control the things that you can control in the mortgage market. There's a lot of things that you have no control over. So if you're not focused on these core elements of the model, it's going to create, chop in your earnings as you march forward. As you look into 2022, if you're not paying particularly close attention to your cost structures and being relevant in the market from an interest rate perspective, it's going to be a really tough period to create, value.
Yeah. Well, David, I really appreciate you sharing with the panel today. It's been just enlightening as it is always. You are truly a gentleman and a true professional in the business. I really appreciate you sharing with the team. David is willing to converse with you. So when we send out the recording, we'll include David's email. And if you want to follow up with David, he is one of the people that is certainly willing to engage with you on ideas, as am I. So with that, really appreciate everybody being here. It's been my privilege. And thank you for devoting some of the time. I hope it helps you work a little bit more on the business and brings you a little bit more efficiency, a little bit more profit, and most importantly, a little bit more fulfillment as you work on your business. So for David Fitzell and Jim Deitch, thanks so much, and have a great rest of the day. Thanks.
Have a great afternoon. Thank you.
Thank you.